Well, welcome everybody to the RVC Community Webinar Series. I'm going to give just some introductory comments here and get things kicked off, and just a little bit about RVC. For those of you who have not been part of this series, RVC is a nonprofit organization. We're the longest running angel group in the US, running since 1985 here in Colorado. We have over 200 accredited angel investor members through various chapters and interest groups within RVC. And we do about 140 events every single year, this being one of them. So that's, if you can kind of do the math, that's almost one every other day. So we're super busy putting on lots of content for folks in the investing and investee community. So some things I just want to call attention to, something that's coming up in November. We are running a new flavor of our Hyper Accelerator program, which will be the Pandemic Tech Hyper Accelerator. And so if you know of companies who are early stage looking for a 1-week acceleration program with great mentors and lots of good content, we will be running that November 9th through 14th. And then we will have a demo day in January. So that's, we just opened that up for applications this week. So that's coming up. Some other things about RVC. As an organization, we see about 1,500 deals a year, and we pitch to our various groups about 75 of those, and then we'll invest in maybe 25 or 30 of those every year. So that's a couple a month that we are putting together. So far, pandemic has not slowed us down this year. We've done about 19 deals as of this week, and right on track. The other thing that's important about RVC is we have syndication partners across the US. So when RVC invests, we share our diligence and all the term sheets and all of the background information with other micro VCs and angel groups. And we are all about collaborating and working with others. So we have spent years creating relationships, and we hope to make that easier for entrepreneurs by sharing those relationships with you all. I just want to point out that people who are members of Rockies Venture Club are also, by default, members of the Angel Capital Association. And I was just on the ACA board meeting this morning, and they were reminding all of us of the great webinars that they are putting on regularly. So I just screenshotted this to remind folks that these are like $100 each if you're a non-member. But as an RVC member, you can attend these for free. So if you just go to angelcapitalassociation.org, you can see that list of webinars. And not only do they have a lot of good new stuff coming up, but they have posted for members all of their archives. And so there are, just tons and tons of things, ranging from valuation to tax breaks to, you name it. And some of the best speakers in the country are on those things. So for today, we'll be talking with Tom Spier, and he is CEO of Boulder Food Group Partners in Boulder, also co-founder of Evol and former COO of Bare Naked Granola. So he has been in this space as an operator for a long time, and now in his second fund, investing for quite a while. And so for Boulder Food Group, it's about a $100 million fund, and they're investing in food and beverage companies. They are looking for companies who are, looking at about $1 million run rate, more or less, or clear sight to it. And they like the organic, non-GMO, better for you type products. So with that, I'm going to, that was a quick intro, Tom. If you want to go a little deeper and let us know what you're up to, that would be awesome.
Thanks, Peter. I appreciate it. So nice to be here with you all today. My name's Tom Spier, and I'm based in Boulder, Colorado. I don't have a number of slides or anything to go with today, but I figure I could talk a little bit about my experience and then answer any questions that you all may have. My career started in food and beverage in 2004. I graduated from college in 2000, and I had spent about 4 years in New York City doing finance. And then my college roommate was really nice. They were looking for someone to come on board and help manage the business, which was Bare Naked Granola. And I told him I would help him find the person to do that. I certainly didn't have the qualifications, but for whatever reason, they were nice enough to kind of give me a job, and that put me into the food industry. And it was a great transition. I certainly liked the real estate field, but the food industry was more dynamic, and being an operating company just provides for different type of profile than being a building, I guess. So from 2004 to 2007, we ran Bare Naked as a private company, and in 2007 we sold the business. Goldman Sachs helped us sell the company, and Kellogg's was the buyer. I'm originally from New Mexico, so my wife and I, we were recently married, and after the sale, we decided we wanted to move out to Colorado. So we came here right after the sale, basically, and we spent about a year skiing, which was awesome. And then during that year, I met a gentleman named Phil Anson, and Phil was running a food company in Boulder called Phil's Fresh Foods, and Phil was making all kinds of products. But he was making some frozen burritos, and we saw an opportunity to kind of reinvent what was happening in the category and try to really change the game a little bit, using burritos as kind of the entry point, but certainly trying to extend further beyond that, which we ultimately did. And over the course of about 5 years backing the company, we scaled the business basically from about $1 million in sales to 20, 30 million in revenue. And we sold the business in 2013 to Boulder Brands. Boulder Brands is probably a company that many of you are familiar with. Boulder Brands is now part of the ConAgra Pinnacle system, as is Evol Foods, the brand that we were working on for those 5 years. And after the sale of Evol, I was really fortunate. I met some great supporters out of New York City, a large family office, and they were looking to get in. They were already in the food space, and they had been for hundreds of years. But they were looking to really enter the venture realm and the world of that we live in Boulder. And they were very supportive of the idea I had to launch a fund to go after this space and not just do it one deal at a time, but try to do a handful of opportunities at a time. And so in late 2014, we launched BFG, and we've been running it for 5 years now. We've made over 20 investments since inception out of 2 funds. The first fund was 55 million. The second fund, approximately 107 million. We are still very actively deploying out of that second fund, making investments certainly in this post-COVID world. We've been fortunate. We've had 2 exits, one of which was announced a couple weeks ago, and it'll fund, hopefully in about 45 days. But that's put us in a really, pretty good position for an early stage VC. And, I feel like, the world has definitely shifted a lot, but the opportunity within consumer packaged good is still, as big as ever, arguably bigger than ever right now, although that'll probably start to change again at some point here. And no, it's been a really dynamic, exciting career I've had so far, and it's a pleasure to get to, speak with you all for a few minutes today about it. So thank you for having me.
Yeah, thanks, Tom. It's super exciting. And, so you've got this real estate and food background. I'm wondering for the investors on the call, so we have a mix, by the way, of investors and founders. What do you think the differences are in investing in a CPG deal versus enterprise SaaS deal? The deal size, time to exit, overall strategies. I mean, you probably write a book on it, but what do you think the top 1 or 2 things are that make this space really different than the typical tech deal?
Yeah, well, our sector is changing. I would say, I've come from a pretty traditional approach in terms of understanding, really how, strategic buyers might think about valuation down the road if you can really realize the growth. Certainly later stage private equity as well, but trying to path a company towards a strategic buyer is really attractive. both for the venture firm and for the founders, because it tends to give you a really clean outcome. Mostly cash or all cash in a lot of cases, and that's quite attractive. The public markets today, and this may change again, are maybe as healthy as they've ever been in some ways, with the number of paths to market that are now available through opportunities like SPACs, which are clearly, it's the word du jour, and I guess rightly so. I mean, clearly there's not enough opportunity out there for Main Street investors in big names, and they feel like there's going to be better opportunity in earlier stage ventures. So there's a lot of capital flow there. So I would say that is a bit of a change of the game, and maybe some of those IPO opportunities were available to SaaS before. It seems like that's starting to open up to consumer and areas like food tech, and so that's a bit of a change. But no, I think valuations have certainly come up in our space. I know SaaS valuations have as well. So we're dealing with, I think, a lot of the same opportunities and challenges that SaaS investors are facing in the consumer side. And it's for an entrepreneur, if you're a SaaS entrepreneur or consumer entrepreneur, it's a great time to be an entrepreneur.
Yeah. Well, it seems like in food, there's a lot of opportunities that are maybe not available to SaaS companies. And there's some shifts more toward, frankly, the kind of thing you're doing, more natural foods. And a lot of sort of, older brands are looking to catch up quickly through acquisition to position themselves to be in that healthier, better lifestyle sort of space.
Yeah, that's right. It's it really depends, right? It's very specific, everything we do, right? It's not a one size fits all opportunity that we're going after. So it's usually category specific. And you really have to be careful going in, because if all the big players already have, their bets made there, then you might end up not having a great home for the opportunity. So, we've invested in a lot of categories now, and I think it's a good approach, and it's a diverse approach. But you just have to be thoughtful, because sometimes, and especially right now during COVID, when the growth is so easy for the big companies in consumer, they were for the last decade they've been on their heels by and large, because small companies have really taken it to them. And during COVID, a lot of the volume gains that have happened have really gone to the biggest companies, because they have the largest supply chains and they can push the most product through those supply chains. And so it's, right now they're, I would say, by and large, most of them are kind of dealing with that. And understandably, I mean, having that much growth in a consumer business that was unexpected is hard to manage. And I'm sure they want to capture that, but I do believe they'll be back in the next 12 months, and they're back already. I mean, deals are happening, but some of them are kind of pencils down, because they're working through their balance sheet. They've got maybe took on a huge acquisition on something, and they're trying to digest, or they're just trying to deal with the supply chain of COVID.
Yeah, a lot going on there for sure. And by the way, I'm going to go back. Maybe for the non-investors in the group, you could define SPACs and why that is sort of a preferred method right now.
Yeah, there's special purpose acquisition companies, is what it stands for. They are entities that are designed to be public. And so they become public essentially when they find the target, meaning a company that they can acquire through the SPAC process. And through that process, these companies become public and essentially, have a new set of governance once they're public companies. But I think that's pretty much what happens. It's kind of like a typical, I don't know, the money, I think the money tends to be prearranged. Maybe I've never done one. So just before this call, I was on a call with Canaccord Genuity out of Vancouver. and they have been a very, very strong underwriter the last few years, particularly in an area that we don't work in. But as people may be aware, cannabis is legal in Canada, and Canaccord's had a field day running IPOs in that area and raised millions of dollars doing that. And now they're doing the same thing in these other areas. And from everything I'm hearing from firms like theirs, there is just a lot of demand from the Main Street up there and in other parts of the globe for these type of opportunities.
Yeah, yeah. Well, certainly it seems like when people talk about doing IPOs, that's it's just such an ugly thing to get involved in, and a SPAC seems to make that lighter and faster and sort of prearranged in a lot of ways. So
that's right.
Good path to that.
So we'll see. We'll probably end up trying to figure it out with one, because it's just incredible. Some of the some of the valuations are just it's way superior to what's happening in the private markets, where the valuations I consider pretty good. I mean, if you get a good company, you grow it nicely, and a strategic takes you out, it's usually pretty good. But what's happening in the public markets is just insane.
Yeah. Yeah.
And I think it's going to explode. It's got to go backwards, but it's hard not to want to look under that rock.
Well, it seems like with low interest rates, there's a lot of capital looking at equity investments, and getting involved in this kind of thing allows various funds or ETFs to get in on it, as opposed to having to do private deals. So there's a lot to be said for it.
Yeah.
So, and by the way, I just want to remind folks, I do see a question from Jamie. I'll get to that. But you can either raise your hand and interrupt if you like, or type into the chat. This is a casual chat. We're here just to have fun and make sure you get your questions answered. So just pop in and interrupt if you like, as we're discussing whatever things are interesting to you. But I did want I've got a ton of questions, but I'll just ask one more, and then we'll hopefully let some other folks ask. But I wonder if you could talk about just Colorado, and specifically Boulder, for the natural food and beverage industry, and what are the benefits of being here as opposed to elsewhere in terms of people who are starting up businesses, investing in this type of business. It just seems like it's really a strength for our community. I don't know.
It's great for Colorado that there's this much of a concentration of human capital and brain power here, and I think it does help to accelerate companies quite a bit. With that being said, you can have a great company come from anywhere, so it doesn't have to be here. I mean, certainly we are making investments all over the country, and even beyond the borders of the U.S. So. But Boulder has, there's just a lot of folks here that have done well, understand the industry pretty well, or their domain within it, and I think have been willing to give back and invest their own capital, invest their own time in other ventures, and just knowledge is really valuable, as it turns out. So I think that's and it's just kind of piles on a bit as more and more companies are here. So there's a big talent pool here. I'm sure there's great talent on this Zoom chat today, and a lot of really smart folks that are here in Colorado that are wanting to be a part of this. So it's been really, really helpful. Bare Naked was based in Connecticut in Fairfield County. There was some other consumer product companies there, but really Nestle Waters was the biggest by far. But by most of the talent in that area was really focused on hedge funds and really financial services more than they were on true kind of entrepreneuring the way the way it is. So, but yeah, Boulder's great, in Denver too. I mean, Denver, I think there's quite a big good stuff going on there. The company we are exiting right now, Birch Vendors, which is a breakfast platform. They're based in Denver, so the Front Range is good.
Yeah, no, it's totally awesome. And I just want to go back to you're mentioning Eval. You grew it in 5 years to 20 to 30 million in revenues. Is that
that's right? That's right.
That's like incredible. I always think of CPG, you've got, all the issues of getting into stores, you've got manufacturing, co-packing, inventorying, all of this stuff that are all, compared to spinning up AWS servers, for SaaS folks,
Yep.
that's really amazing growth.
It's good. I mean, I'm going to brag. We are a part of one investment that, in 3 years went to 100 million, and
Uh-huh.
it's frozen food product. I mean, and that supply chain it was hard. I mean, this is really hard to do. You're not just, adding, stacking servers. This is about getting product off manufacturing lines. So it's, it's good growth, and you really have to stay ahead of it. You need really strong planning. And it's just, you got to have a committed team. But yeah, teams can really do amazing things though. So,
Right.
you know.
So let's go to some questions here. And Jamie's has been up there for a while, so I'll just start with that. So for you guys, when you write a check, what are your typical check sizes? And I'll expand it a little bit for initial investment, and then what's your follow-on strategy that you would have?
Sure. So it's really pretty varied, for some, for the sweet spot of a company that really does kind of hit the profile of what we really are looking for: margins, growth rate, people, brand, white space. We'd love to write, meaningful checks for us, which would be like 6, 7, 8 million. With that being said, we are seeing a lot of opportunities that are really early stage. And, while we love to have a lot of conviction up front, we quite often do make seed size bets as well. So that would be checks more in the magnitude of like 500,000 to $1 million. And so our portfolio is designed a bit like a barbell. And on one side, it's kind of seed stage deals, and it's a kind of a small bucket. And then the other side, it's more weighted on companies that maybe have a little less risk because they already have more meaningful scale. So that's really the approach. And then hopefully some of those seed stage deals will develop, and we'll be able to deepen our allocations to sizable amounts, maybe as much as 15 million for any one company out of this fund. Our max investment in any one company today is approximately that much money.
Yeah, because that'd be 15% of your fund, and that would be.
You got it.
That'd be about
for
right.
For a venture firm, that's pretty sizable.
Yeah. All right, that sounds great. Jason asks, any opinions on the last mile of prepared foods and the losses Uber takes, for example, or grocery stores entering this market? Hard to avoid declining ingredient margins.
It's really hard. This is an area that, a lot of competitors are going after, and there's some really, really powerful ones out there now doing it and throwing capital at it. It's probably an area we're going to continue to stay out of because it is so capital intensive and the margins are tough. I don't know that anyone's really found the magic formula at this point. It's just a hard, if you start to make the food yourself, you're all of a sudden a restaurant, and, running restaurants and personnel and everything that goes in with that is, you're a restaurant. That's, I don't think you probably should command a tech margin if you're a restaurant.
Right.
So I think that, it's going to be a big opportunity probably for a while, just because the market's so big. But I think it's going to be highly fragmented for quite some time to come.
Yeah. Well, I've seen stories about how that is struggling right now, and so it's not a no-brainer by any means. But we did invest in a Fort Collins company called Food Corridor, they're not really in that delivery, but they're in the commercial. It's sort of an Airbnb for commercial kitchens. So it allows that person who wants to do the pop-up thing to legally do that, or it allows a startup, natural food company to have a legal clean kitchen that they can use to develop their products.
Yep. Yeah, that's. There's going to be value created here, and there'll be there'll be some nice businesses formed, but it's just hard to scale this stuff. Yeah,
it is. And then Jason, I don't know if you want to just jump in, but I don't know if you can see this, but this. Somebody he was at a DU alumni dinner with your co-founder. Wanted to be reminded of what his name was.
Oh, that's Phil Anson, probably.
Phil Anson. who you just mentioned. Yeah.
Yeah. Yeah, Phil, and he's in Boulder. He's working on some neat companies right now, helping out private equity firm out of New York called Alliance Consumer Growth. That was a partner of ours at Evol. Once we, ran out of our own cash. So, um, let's see what other questions here.
So we got next one is, what are the trends you see in sustainable packaging? You see any cost-effective alternatives to plastic? Any thoughts on reusable milkman type packaging like TerraCycle's Loop?
Yeah, it's all kind of happening. It's just, it's incremental, and I think on a cost basis, it's still expensive. So I think that's really the biggest barrier for a lot of it. When you're talking about trying to scale consumer products into mass merchandise, and you're trying to hit price points that are competitive with your competitive set of products from, General Mills or Pepsi or whatever, large company is out there, your price points are just going to have to be pretty tight. And I think that's where it gets really tough for, I would love it if obviously plastic was, gone from consumer products. I mean, I do think plastics have a place on our planet in areas like medical devices and such, but, do we really need plastics covering all our food in the store? Like, probably not. So the faster that happens, the better. And if we saw an investment opportunity in this space that we really, really could feel firmly about, we'd probably do it. But there is, quite a bit of money and, knowledge chasing the segment too. And we just don't want to go too far afield from really what our skill set is.
Yeah, that totally makes sense.
Yeah.
But you have on your website, it's you clearly sort of have a values-based orientation to how you invest. You're obviously looking at economics first, and scale and market and all of those things. But you've got this. How do you think about that sort of value-based investing, where you're thinking about sort of impact, and this plastic being one of those things?
Yeah, the plastic side is definitely an ugly mark on our credentials, I would say, in terms of sustainability. I mean, but it's it's unfortunately kind of part of the business right now for us. So we do try to identify products that are going to be a real step up in health and wellness for folks. So the deeper we go into investing, I really think that's first and foremost, and trying to identify products maybe with lower sugar, products that contain more vegetables, products that are better for the environment because of their they rely less on water usage, or hopefully maybe kill fewer animals. These types of ideas. So again, we're not putting such strong guardrails up to really limit ourselves, because we are a financial investor. We do not market ourselves as impact first and foremost. I mean, if we're doing the impact, that's just gravy on top of it. But it's we're definitely trying to make thoughtful decisions about capital allocation that reflect our moral judgment.
Yeah. Well, and some of that, impact is great, but there's sort of increasing market demand for, so you're not being an impact, like a concessionary impact investor, but the more that consumers demand less plastic, then that's where everybody's going to have to go. I mean, my wife won't buy anything with plastic on it anymore if she can avoid it.
It's really hard to do. I mean, as with 3 kids in our house, like we have too, it's just it would definitely be a game changer if we bought it, didn't do any plastic. But I think that's awesome.
Yeah.
And we'll get there as a country, and I think the consumers will demand it. Younger consumers are thoughtful about this. I mean, COVID, to some degree has thrown a wrench in it, because safety is paramount, and I think people are taking that seriously. So, these barriers are important for safety.
So speaking of that, so Jason's asking another question I've never heard of, using transparent aluminum for reusable containers. Is that a thing?
No, that's pretty neat though. I if it's possible, I'm not a metallurgical engineer. I know one. I could ask him and that's a really interesting idea. Right now, aluminum is under short supply. You've probably read about it or heard about it. So, yeah, but yeah, aluminum, yeah, transparent aluminum would be neat.
You want to talk about that, Jason? I've just never heard of it.
It's worth curious.
First chatting.
Transparent aluminum. I'm seeing it on the internet, so there's probably about a 7% chance it's true.
Yeah, or it could be super expensive, although apparently the cost is dropping.
Right.
Yeah.
I mean, the other thing is just the processing steps you have to go through to get something there. You do have to kind of always question that. I mean, some of the stuff in some of these products that are coming out that are sustainable and maybe made from corn or something. I mean, there's not, it's usually not just, corn. There's usually some crazy chemicals going in there. So I think you have to be, really dig a little deeper.
Yeah.
Yeah.
Well, I'm going to, while other people are thinking about their questions, I'm going to go back to some finance questions. So when you exited, you went to Goldman Sachs to help you to sell the company?
Yeah, Goldman sold Bare Naked for us. We've transacted Evol with Houlihan Lokey. Piper Jaffray has sold a couple businesses for us as well. And so, yeah, I've had a good experience working with a handful of the investment banking partners around the country, and certainly have some good experience there.
So one question that we get a lot is, when your company is growing, when's the best time to first approach these guys to start developing a relationship and sort of see who you're going to want to work with and so on?
I think that, I don't know if you have someone in your organization that's really focused on capital raising, probably they'd be the right person to probably do that. If you're really making a mark, you're going to make a mark with your consumers. People who deal in money, whether they're investors like ourselves or investment banks, they'll find you. And so I wouldn't probably spend your time on it. There are a handful of periodicals out there and publications that if you subscribe to, it's pretty easy to find out who's doing what. You just take some reading and a little bit of knowledge on where to find that information. But with that being said, if you feel like your company is growing, no one's calling you, and you're all of a sudden, could use some advice, you better find out who to talk to. And I think having a perspective from capital markets is really important. I think one perspective is probably not enough. If you're going to talk to one group, you should probably talk to three groups. It's pretty likely all these groups are talking. So if you're talking to them, just know that. So just be thoughtful about what you say.
Yeah. Well, one question that comes up is, let's say you're growing nicely, you're not working with an investment banker, they haven't reached out to you, but an acquirer comes to you. Is that a time to engage somebody, or you've already done half the work and you just work with attorneys who are smart in the space and just get the deal done?
Yeah, I don't know. I think that it depends on the nature of the relationship. Sometimes introducing intermediaries can create problems with and create a lot of just from the buyer. They might really kind of get skittish and feel like they're going to be the stalking horse bid all of a sudden, and that can be unattractive. So I do think having a intermediary involved to help create tension can be helpful, but I don't think it's a must-have. If you don't have an investment bank that's getting paid a fee, at least having some additional advisors around the table to help think through some of the key negotiations would be highly recommended, even if it's just on a monthly retainer and you're paying a smart group of folks who have been through a number of these transactions before.
Yeah. Well, it totally makes sense. And I'm thinking about, I don't know what the trends are in terms of acquirers, whether they tend to make fair offers and you're good to go, or I mean, the main reason to engage somebody at that point would be get 2 or 3 other offers and shop it a little bit.
Totally. No, it's right. And, I think that knowing what, if, in the private markets, like what is something worth, it's, again, these aren't real estate deals that have a certain amount of NOI that you can throw a cap rate on and look at all of their cap rates for similar assets. This is a very different type of asset class. And it's all about margins, future distribution gains, the consumer, how likely the consumer is to follow the brand into other areas in the store. And there's just enough going on there that it's like, I don't know, the pricing on this stuff is so all over the board. It's hard to know. I mean, if as a seller, you feel like you're not getting enough, then of course, I think you're going to want to go look elsewhere, but it's, you never know. And you'll never, you even if you hire a bank and if they talk to the market, there's still probably a bunch of buyers out there that might have been a bidder that you're never going to reach.
Right.
The market's so been, so broad.
Yeah. Yeah. And then you can screw up that one deal with your earlier point.
Yeah.
So.
And if someone's, if they're going to pay you cash and you feel like the price is fair, that's how deals get made.
Right.
When we're going to make investments and stuff, I mean, we're hoping that companies are not shopping our negotiations and they're dealing fairly and, straightforwardly with us. I mean, it's fair of them to shop, to talk to others, of course, but, it's, if we're, we don't ideally want to just be played like that. I think that we're trying to be sincere with our approach and we appreciate that back.
Yeah. No, that makes sense. Yeah. So here's a good question. So how do you estimate when a certain product category may be oversaturated? For example, a certain number of plant-based burger brands may suggest the segment may be overripe. Is there a sweet spot of when you're seeing consumer adoption intersect with a limited number of brands in food and beverage?
Yeah, I think that, getting to that kind of top tier leadership position in a category is really important to help to get to an outcome. It's easy to get into private deals. It's hard to get out. So you need to get to 1, 2, or 3 position to get out. That's kind of, in layman's terms, what needs to happen. And so if you feel like it's impossible with the competitive layout to get to that place, you got to question why you're making the investment, or it's such a deep category that there's going to be more than 3 outcomes. So that's kind of a simple way to think about it. But yeah, I think plant-based burgers is incredibly crowded. It's a huge market, of course. And, it's not just burgers, right? There's a lot of other cuts of meat and other opportunity within animal, replacement. So I think that's probably where some of the opportunity has moved to, because I think the plant-based burger segment is overcooked. But, maybe in terms of some other cuts and other opportunities, there's still ways to do well there. According to this Canaccord Genuity, they think when Impossible Foods comes to market, it's going to be just a blockbuster IPO, and that this firm Memphis Meats, which is the cell-based agriculture meat company that is, I think, this much revenue, that's going to be insanely profitable, IPO. And so I think it just, where this is, I think the world is headed to a place where these foods are going to be much more commonplace, and there's a lot of volume to be captured by these leaders. It's just, the race is on. And if you're not kind of in there, taking big pieces of share now, it's not going to get any easier.
Right. And some of them, I almost feel like we're on a 1.0. Like I'd like to see the quality of some of those things get better. But I agree. You got these big players in there right now. Doesn't make sense.
Yeah, they're all in it. I mean, they don't get any bigger. I mean, Nestle and Tyson, and they're all, want to be a part of this. Right.
Well, let me take you back down to, companies that are just starting out. So they're, way before they would come to you at sort of, concept stage. What are the sorts of things that a smart company is going to do in terms of, setting up relations with co-packers, or just, what are ways to get into distribution, that kind of thing. Some of those things that are obvious to you but not clear to somebody who's got a concept they're working on.
Yeah, those are all areas we can certainly opine on, and there's usually better answers than worse answers in terms of strategy, but there's no kind of absolute way to kind of go in terms of co-pack or make it yourself. There's certain areas that, and in this day and age, maybe making it yourself, if you can really do it really well and, have a bit of a competitive advantage because of that, that might, start to look more attractive here. Co-pack can be really, really useful. I mean, we've had wonderful outcomes with co-pack. So it just depends on the category and what supply is out there. If there's tons of available capacity, trying to, for, bars or, getting products in cans. I mean, I think that's one thing, but it's, no, it's, we do have a few companies that make it themselves. It's when you're subscale, trying to make it yourself, it tends to be very expensive. Right. So you just have to be able to get through that period, and then hopefully you can grow the top line and also, make the gross margin to a point where it's really a real business.
Yeah, we had a company we looked at a few years ago, and some people at RVC invested, but we did not invest as a group. And they were basically losing $2 for every unit they sold, and hoping that as they scaled up, they could make it make sense. But it's I don't know. I don't think that they ended up doing that well.
That's really hard. It's super scary. I mean, sometimes the companies can go from that negative margin, but margin is, without a good margin, it makes running a business so hard.
Yeah. So let's just talk about that for a sec. What is a good margin for somebody who's in their first 1 to 5 million in sales? Just at that scale.
Yeah, it's I'd say that a really good gross margin in food and beverage would be maybe 60%. That'd be after trade spend. I mean, if you have that, then you really have a super healthy gross margin. You're going to be able to hire good people. You'll be able to spend on brand marketing. Hold on, give me 1 second. My dog is going to just claw the door.
Yeah, second. We don't want that.
Here, hey, go outside. Sorry about that.
No worries.
So no, it's I think that, but 40% is like the minimum. Ideally that you want to be able to kind of strive towards, because if you can get to that 40%, I mean, look, 30% you might be able to do it if you get enough volume, but I think 40% gives you more wiggle room, and then the higher it goes from there, the better. And certain categories are going to have higher margins typically than others. I mean, it's personal care, beauty. I mean, margins there tend to be higher than they are in commoditized categories. You're never going to, if you're in a 60% margin business in the Alden business, I mean, that'd be amazing. I don't think that's happening now.
Right. Yeah, makes sense. So, and then just, I'm just thinking back on some of the companies we work with and how they are looking at scale. Once again, in this early sort of getting through that $1 to $10 million zone. So you grew through that very quickly with Evol and with Bare Naked. So what were sort of are there tiers of distribution that you can get into as you're at certain sizes, and what are the strategies around thinking about the channels you use?
Yeah, I mean, it used to be, when we started Bare Naked, it was kind of, natural channel, Whole Foods, regional Whole Foods, ground game. Now that's harder because Whole Foods is Amazon, and they've, and during COVID, everyone is trying to scale back the number of SKUs too, because they're managing more volume and trying to deal with less SKU complexity. Right. So I think the opportunity really is direct to consumer, really, to try to get things going and then prove that the demand is there and that there's the right product market fit. And we're seeing and hearing about products that are launching online and as fast as we could get to 10 million in retail, they can get there online. So if it's the right product, if they know how to do the outreach, do the marketing tactics to execute an online strategy, it's possible. You need the right products and the right execution.
So how many companies do you think are successfully doing that direct to consumer strategy? I mean, I know a lot start out that way, but
Yeah, I
that's
think
cool.
eventually most in food and beverage ultimately decide it's better to go everywhere, because the vast majority of volume for food and beverage is still sold uh, beyond direct to consumer. So for areas like beauty and personal care, there really are fewer set of, it's online is a much bigger piece now than retail. And then in retail, it's really some key providers, right? Your Sephora, Ulta, maybe Target. But it's a little bit of a different playbook depending on what category you're talking about.
Right. Well, is this a true story that Phil Anselm was doing direct to consumer out in El Dorado Canyon with the first burritos and coolers of burritos selling to climbers?
He was direct to consumer out of a cooler.
Yeah.
Right? But he was doing it. He was ahead of his time.
I remember hearing that story years and years ago.
Yeah, he self-described dirt bag climber, but he's not. He's a great guy. So.
Well, dirtbag climber isn't necessarily a bad thing.
Well, yeah. Well, maybe he is. Then I don't know.
I used to hang out with them all the time. They're good folks.
Yeah. Well, he's awesome, and yeah, definitely has taken a lot of his climbing skills and translated it to the garden. He's got a beautiful setup out there. So
nice. Well, I just want to pause for a second. I feel like I'm dominating this and sort of invite other folks to ask questions as we go along. I'm seeing folks who've got some experience or space in this.
What's the typical check size you guys are writing when you're pulling together something? What does that look like?
So our typical deal is we're sort of doing the first sort of professional angel round. So usually somebody's gotten some traction beforehand. Most people are raising between 500 and 1.5 million. So 750 is a typical raise. And then RVC, we'll typically do on average maybe a third of any round with our investment. So we'll put in 350-ish into deals, and then we will work, as I mentioned in the intro, to bring in syndication partners and try to close out the round, just with broader, especially tapping into the Angel Capital Association and groups there. So those are all forks. We have sort of shared diligence expectations. So, we have to write up something formal that other groups can use, as opposed to having had a beer with founders or whatever.
And are you typically taking a board seat, or how does that work?
It's about 50-50. So we don't get to lead every deal we do. We prefer to lead when we can, and then we will often have that option for the board seat.
Yeah.
But certainly we like to do that, and then board observer if we can't do that, and then obviously some we're not. We're a small bit player on a company that's gotten bigger or moved faster than we could have gotten into.
Yeah, that's what's amazing to me is just the capital flows are increasingly impressive out there. It's just I wonder where all the money's coming from, but it's it's just amazing, just the size of these rounds that are happening for companies that are really very very small enterprises. And so that's just a lot of money to put on a business that has to really grow into these types of valuations.
Yeah. Anybody who's been doing angel investing for a while struggles with the valuation trends, especially over the last 3 or 4 years. I think there's two big trends I see going on, but the size of checks is so much bigger, and things are moving farther upstream. But the valuations at our stage are becoming, where it's not that interesting a lot of the time. And we'll tell people, go to California if you want to, have a $6 or $8 million valuation at a startup phase. Doesn't make sense.
Yeah, it's just that's right. That's kind of where pricing's gotten, and it's just it makes it tough, right? And obviously before I was doing this, as a full-time career, I was writing angel checks myself, and had a portfolio of called 15 investments or so, and it's you definitely it's hard. It takes a lot of work to do that, and to find the deals, and to really build the conviction to write your own check. And the valuations, it's got to be tough. I mean, but with that being said, if you show up for the right deal. I was talking, this company Sweet Smarts out of Vancouver that just transacted to TPG for approximately 300 million. They did I think one round of financing. The first round was sub 5 million valuation, and it was like 3 years ago, and these people made 70x probably.
Yeah. No, that's nice when that happens.
Right. No, I know, but that's kind of angel investing, right? I mean, you're gonna have to make enough bets because some of them might send you the money back, but it's like, I mean, I'm not the first one to say this, but very thoughtful people who've done a lot of angel investing say you got to write, 50 checks or something, or 100, or
yeah.
For most people, that's more. That's like day and night thinking about this stuff.
Yeah. So we're offering a new vintage fund concept where somebody can basically buy into the Rockies Venture Club Vintage Fund and get a share of everything we do in 2021. So effectively, you write one check and you're in 25 deals. And that's
I mean, I do feel. I mean, unless you really, as an angel, love the working with the founders and kind of doing that. If it's like you really love it, then it makes sense. But otherwise, what you just suggested is makes a ton of sense, right? Because that gets the dollars there. But administrating this stuff is it just that? It's administration.
Yep. We have just a few more minutes, but we got 2 more questions came in, so we're going to jump on these. Here's one from Stefan. Our company is in the process of developing a food beverage cannabis accelerator program based in Denver, wondering how people, and this could be anybody, but wondering how people feel about this. And I wonder I'll just ask you how you feel about cannabis in general, and then how you feel about accelerators in creating deal flow.
Yeah, so we have not made any investments in the cannabis sector at this point. I suppose we could. We'd want to ask our biggest investors if they were okay with it, if we ultimately found something to do in the space. And it's undeniable that there's a lot of volume moving through cannabis companies. I mean, it's just it's clearly a huge piece of the economy right now, and so it really would be nice if our government would get it right and give the pathway to folks that would like to be investing in exciting segments like this, and do it in ways where you don't feel like you're going to be breaking the law, because I have no interest in doing that. So to me, it's there's probably we could structure around it and figure it out. It's just it's less than optimal if I don't know, but certainly the friends above the border in Canada and Canaccord Genuity think it's a really good idea, and they seemed extremely happy for having made the decision to go full head in on it, because they've just done great. So I think that for Jason, I think you should, if you have a network of folks and you can get everyone together and start to, leverage each other's, knowledge to help accelerate each other, that's fabulous. So I'm all for it.
Mm-hmm. Yeah, well, and there's some unique challenges there as well that certainly having a group like that would help.
Absolutely, and there's some very smart people in Denver and attorneys specifically that I bet would love to be a part of it, because
sure,
probably love to sponsor it. Really, I'd run straight to a few attorneys and see if someone will get you going.
Yeah. All right, I'm going to go back up to one I skipped over here from Mladen. Do you see supply chains moving more local from factors like shock from COVID as well as stronger focus on transparency and human rights and environmental concerns?
I believe that it'll continue to grow local, I mean, relative to, what's happening now. I think local food is, it definitely has a lot of room to grow, but I think we live in a pretty globalized world. And I think a lot of the, flows of products and pricing on stuff is still going to be dominated by these, scale operations. And, I love the idea of organic, small farming operations, kind of a simpler, world, but unfortunately it's just not the direction we're headed. And I think we have to, just that just is something, I don't know, it would take a real change to, I think, for really truly young people all across the country to want to go back and be farmers. I just don't see it happening. And
Yeah.
unless that happens, I mean, it's all going to be about, large operations and a lot of machinery and capital.
I would agree. I think I see a lot of trends where people want local, but in all practicality, I wouldn't be investing in something local because just by definition, we want to invest in things that can scale and are not local.
Yeah, and I think that it's it's like a vineyard or something like that. I mean, if someone has a passion for it and can ultimately make a small business work for them and make it profitable, then that's great. It's just it's just not a place for venture type returns. I mean, it's a much different approach to. It's not it's just a different approach.
Yeah. I love going to local farm to table restaurants, for example, but I wouldn't ever invest in those. Any restaurant for that matter.
Yeah, no, I've invested in restaurants.
Have you?
It's hard.
Yeah. Yeah. Understood. All right. Well, on that note, we are out of time. So I just wanted to thank everybody for being here.